Okay, so maybe the recession hasn't quite begun, but history would suggest we're sitting right on the edge. It should begin sometime between now and March, which coincidentally is about when the Fed is expected to start cutting rates. So what we're going to do is figure out if historically this is a good time to be invested or a time to be sitting on the sidelines. So let's look at the facts and history together.
I don't want to answer your question about the recession.
Okay, welcome back. Okay, so here we are on the St. Louis Fed's website. Great website, tons of data. So what we're looking at here is the yield on the 10-year Treasury bond minus the yield on the 3-month Treasury bill. Now, in normal situations, normal times, when I commit to a 10-year bond or lending money for 10 years, I would typically expect to get a higher yield over that longer maturity. But right now what's happening is you can see we're negative, we're below the zero bound there. That's what we call the inversion. And the inversion is when you're actually being paid more for the 3-month Treasury bill for lending for only 3 months at a time versus lending for 10 years. Now, a point of confusion is you're not actually being paid more, it's that you're being paid more per annum. So it's not 5% for 3 months, it's 5% should you, I suppose buy 4 3-month Treasury bills consecutively, you would get the the current rate, which is 5.4% for 3 months, and 4.2 for the longer duration. So what's going on right now is a bit backwards. It's a bit of a weird situation. It's this inversion, and it's historically had some predictive power, and that predictive power has predicted recessions, sort of 12 to 16 months out from the first inversion. Now, what's interesting is if you look at 2020 back here, there was actually an inversion back in 2019. So we had an inversion that happened. We were below the zero bound, pretty consistently for a while there. And you might have expected that a recession was coming on that basis. Now, COVID and the crash that ensued was maybe unrelated to that inversion. So maybe it was just a coincidence. In fact, it really was. But you could argue that you might have been expecting a recession anyway on the basis of the yield curve inversion alone. Now, of course, an inversion alone is not really a sufficient reason to be expecting a recession. It is, it does have predictive power though, and there's a reason why the inversion is happening. Greater the magnitude of the inversion, in fact, I would argue, is almost a stronger indicator of a recession. And the reason being is that if the 3-month Treasury bill was 12%, not 4 or 5.4%, well, and then the 10-year was something normal like 4%, well, then you have an 8% inversion, not just 2% right now. And that 8% inversion is likely going to cause a recession on its own, right? Having interest rates that high over, some period of time, especially 12 or 16 months. So I would argue, yeah, the greater the inversion, the more likely it is to bring on a recession, in fact, which I would say brings us back to the title of this episode. But anyway, let's move along back to 2008 because that's interesting. So here we are, 2008. Let's go to 2012. Here we have interesting. There's a couple little minor inversions early in 2006. So people might have read into that a little early. I don't know. But then by July, we had a proper inversion happening. And you can see the inversion lasted for a while. Not nearly as deep of an inversion as we currently have. But if you look at, okay, when did it first invert into this, significant inversion? It was July. And then the shaded area here, as you can see, is the recession that began in December. So that's about 16 months between the first inversion and the start of the recession. So, and then you have the recession lasting about a year and a half or so, or a little less. So that's interesting, right? And then what's also interesting is, okay, when do the rate cuts happen in this sequence, right? So if we go here to Forbes, it happens to be, we can look at this on the Fed's website as well. So here you can see the series of rate cuts that occurred leading up to the crash, and then the cuts that happened in the crash, which were aggressive, of course, bringing us down to essentially zero. So that's interesting. Okay, now let's jump back to this. So this is where I've plotted everything on a stock chart. This is the NASDAQ, but it's interesting, right? So okay, here's the yield curve inversion. Interestingly, the market rallied strongly from that inversion for quite some time. That was mid-July all the way until 2008, essentially, or beginning of 2008. So a year and a half, it rallied strongly, or 16 months. Also, what's interesting is the early rate cuts were very bullish for the market. The market loved it and rallied about 10% or more. And there's their further rate cut right near the top. Again, kind of getting ahead of the recession and what was coming. So the recession officially begins here. That's what this gray box is on this chart. A bunch of cuts down here, which perhaps spurred another rally, a bear market rally. And then it eventually rolled over pretty hard. So the rollover was sort of mid-recession, or at least the big rollover was mid-recession. You had a very big tradable rally here. I mean, if you look at that, it was 1670 up to 2050 or so. So that was a very significant rally. Would you want to sit out entirely through this period? Probably, but I mean, there was certainly a very good opportunity there as well. So anyway, interesting, right? And then the big, 100 bips at the end, taking us down to zero, and then it stayed at zero. And this is the thing that a lot of people have a problem with. It stayed at zero until 2015, right? That's when rates began rising again, finally. And that caused a significant rally that just went on and on and on because the market loves 0% rates. And so here we are today, up and up and up and up and up and up. And here we have our yield curve inversion. Here we have our rally. Guess what? Now, this is where it gets a bit tricky. So here's 16 months. So this is roughly 16 months when the recession would be expected to start based on that historical example. Now, the thing is, we haven't had a first rate cut yet. So we haven't had that preventative rate cut, if you will, which, if you recall, was in fact, a near vertical takeoff in the previous chart for a couple months at least. Do you want to sit out because there's a recession coming when there may be some preventative rate cuts? There may be that dovish pivot that I've been talking about a lot. Up until now, the Fed has been pretty hawkish. And so that dovish pivot, along with a rate cut, could give us another significant leg up here. And that's my thesis. That's my base case at the moment. That's what you see here. But ultimately, I do think the recession matters, and I think it wins out. However, this is a little bit different because thus far, I mean, we're not dealing with a 2008 crisis yet. I mean, commercial real estate's getting pretty bad, yes, and there's lots of bankruptcies happening, lots of defaults on bonds and whatnot, or debt. And so, we just don't know the severity of the recession. It's looking pretty soft, right? Thus far, it's looking like a soft landing, as you've heard many, many times. So, maybe the rate cuts and dovishness far outweigh, the recession, the impact of the recession. Because again, remember 2008 was a serious anomaly. Like that collapse was a real collapse. And if you run a back test on a data with a strategy, for example, that you're trying to optimize, the computer every time is going to pick a strategy that optimizes to navigate this well and or to ultimately be a buyer down here, essentially, right? Depending on how smart your algorithm is. And so this, from a training point of view of some sort of model, is anomalous, and it's difficult to work with in that sort of scenario. And so, should we be looking at this saying, well, this is something that's likely to happen again? I'm not so sure. By the same token, I do think if we get a significant rally, as I'm suggesting, based on the dovish pivot and those initial rate cuts, it depends on how much it sends the market higher. But if it sends it a lot higher, then it could be setting us up for a bit of a crash, almost like a valuation crash as opposed to something recession based. Like think about 2000, it was a pretty mild recession initially, but the stock market had a pretty big crash, especially the NASDAQ. So anyway, this is kind of where I stand right now. I think we get that first move up from the dovish pivot, and then I'm kind of allowing myself to be able to reassess as things progress. I really don't know, right? I don't know how bad the recession is going to be that I view as highly likely. And And if it is really truly soft and you know the no landing situation, then this could be a really big rally. Maybe the Fed makes a mistake. Maybe they cut when they don't even need to. You know, that's the other thought here that could occur. Anyway, very interesting. I think this is just, yeah, sort of looking at history and what's happened in the past. There are other instances where it was closer to 12 months where the recession happened. I think that very well could be the case. We could be sitting on the recession already, really, or very close to it. Again, we haven't had the rate cuts yet. So even if that's the case, you know, it's a mild recession, obviously, at this point. And yeah, the pivot and the rate cuts are kind of happening at the same time or a little later here. So it really remains to be seen. And I think we just have to sit back and wait and see how it plays out. But, you know, initial positioning remains bullish. I don't see a reason to be bearish yet, but there's certainly a case to be made for that pivot, if you will, the other way. So next time what I want to do is look at a bit more of the data. I think, you know, there's a case to be made that maybe the Fed doesn't cut rates at all, and maybe the economy remains strong, and that's actually quite bullish potentially, especially given how well we've weathered this rate hiking cycle. And again, technically, I think markets are just set up to go higher. So yeah, I'd like to look at the data a bit more. So we'll do that next time. Maybe we'll even look at some more historical examples too of you know, where the inversion happened and what happened next. I think history can be our guide here, at least to some degree. But again, you know, the data is important. So let's look at the data. Let's not find ourselves set on an outcome. Let's, you know, be reactive to the data and take it into account. But you know, I think you can get caught up in the weeds too sometimes, and we want to avoid that. So let's keep diving into this, and it's an evolving process, making decisions around how to be positioned. And you know, I've been lucky; I've been doing it quite successfully. You know, especially over the last 2 years here. So this one's tricky for sure, but it also has the potential to be, you know, both very good or very bad. So we shall see. Thanks everyone for joining today. Please don't forget to like and subscribe. It lets me know you find some value in what I'm sharing here and will encourage me to keep sharing tidbits of knowledge as I come across them. And on that note, if you aren't also following the portfolio series, just a very brief update. The growth portfolio is up 25.1% and the levered growth portfolio is up 32.7%. So some pretty meaningful returns, that's for sure. You know, inception being November 1st. So a very short period of time. So hopefully we can maintain and build upon these returns as we have a lofty goal to achieve. So stay tuned. Okay, enjoy your day. Thanks for listening in. We'll see you next time.